So let's get started talking about becoming a CFD super trader. Now, the first question you want to ask is CFD trading right for me? Now, CFD trading, and we're going to talk about what a CFD is in a second, is ideal for investors who want the opportunity to try and make a better return on their money. However, it contains significant risk to your money and is not suitable for everyone. We strongly suggest trading on a demo account before you try it with your own money. And if you want, you can go to www.alvexo.com and open a demo account and try it and learn and understand what's going on before you ever put 1 penny in. Now, CFD trading is ideal for people looking for short-term opportunities. CFDs are typically held open for a few days or weeks, but most are closed within the same day. But you do have the ability to keep them open. They want to make their own trading decisions. They're looking to diversify their portfolio. You can either be an active or passive investor, and you can trade as little or as often as you want. Now, CFDs are short for contract for difference, and they are one of the world's fastest growing trading instruments. A contract for difference creates, as its name suggests, a contract between two parties speculating on the movement of an asset. Now, keep in mind that CFDs, or contracts for difference, are regulated licensed products that are monitored and approved by the regulators. The term CFD, which stands for contract for difference, consists of an agreement or a contract to exchange the difference in value of a particular currency, commodity, share, or indice between the time at which the contract is open and the time at which the contract is closed. Now, keep in mind, you never own the asset. You own the rights as given to you in the contract. So what you're doing is you're making a contractual agreement. That's it. So you do not own at any time the underlying asset. And that's what makes CFD so attractive. You don't have to worry about deliveries. You don't have to worry about taking delivery. You don't have to worry about physically holding an asset. And since an asset doesn't have to be assigned to you, like a stock, when you buy a stock on the stock market, everybody has to go through the whole process of registering those stocks to you. That costs money. A contract is simply held between you and your broker. And therefore, the fees are very limited. Now, the contract payout will amount to the difference in the price of the asset between the time the contract is open and the time it is closed. So in other words, if I wanted to buy a horse, hypothetically, or I wanted to buy a car, I saw a new Mercedes and it was $132,000. But I didn't really want it for me. I wanted to make some money because you know what? I had a buddy across town that I know would buy it for me for 140 because he wants one desperately and they're hard to come by. So I make a deal with the selling broker or the selling agency to buy that car. But since I'm not taking physical delivery of that car, I don't have to actually give him any money. Just have to give him a deposit check. So I'm not driving off this lot. So I give him a deposit and he gives me that contract for $132,000. I go across town and I say to my buddy, I got that car for you, but it's gonna cost you $140,000. Buddy says, cool, I want that car. He says, well, I gave $10,000 to the dealer. You need to give that back to me. He hands you $10,000. And then he says, you can go over to the dealer and we'll go over together and we'll transfer that contract to you. So he transfers the contract to him, but the dealer makes the contract for $140,000 and hands me my $10,000 deposit back, as well as my $8,000 in profit. Because the dealer's fine. He sold the car for $136,000, my $6,000 profit. My guy's willing to pay $140,000. He gives me back my deposit, gives me the difference, and I made the difference in the contracted value. Now, What's significant about CFD trading is you get to use what we call leverage. It's similar to using financing. Like I said, I didn't have to give the dealer the $134,000. I would have never been able to be the middleman and make the profit if I had to write him a check for $134,000 and take physical delivery of that car and then sell it to my buddy, because I didn't have the $134,000. Now, the other advantage is in CFDs is what we call selling short. Selling short means you think the value is going to go down. So we reverse the scenario. Your buddy is willing to pay $140,000 for that Mercedes. So you say to him, no problem, bud. I'll get you that car and deliver it to you this afternoon. But you don't have the car. You sell it to him for $140,000. He gives you $10,000. Now you have to hope that a whole shipment of those Mercedes came in, because that way the Mercedes dealer is willing to sell it at a lower price, and you're able to pick it up and deliver it to your buddy. Well, lo and behold, you find a dealer and he's willing to sell it to you at $136,000. You give him a contract for the $136,000. You hook him up with your buddy pays the $140,000, and you made the profit between the $136,000 and the $40,000 because you sold it first and bought it afterwards. The only place in the markets that you have the ability to buy and sell is with CFDs. Now, CFDs also give you what we call leverage. That gives you more trading power, flexibility, and opportunities. So I put this in a presentation for you. I'm going to share that with you. And I'm going to share with you a real simple explanation. And then we're going to go on and talk about some more of the essence of CFD.
Closely at one of the most popular and innovative investment tools, contracts for difference, mostly called CFDs. CFDs allow you to trade on the price movements of any financial market, like stocks, commodities, indices, or currencies, without actually owning the underlying instrument. If you think the price of an underlying asset will go up, you can buy a CFD and benefit from that rise. This is called going long. If you think the price of an underlying asset will go down, you can sell a CFD and profit from that fall. This is called going short. The profit or loss you make is the difference between the price when you entered your position and the price when you close it. The more the market moves in the anticipated direction, the more profit you make, but a position can also move against you, resulting in a potential loss. When you buy a CFD, you don't have to pay the full value of the position, but only a fraction, otherwise known as the margin. This practice is called trading on margin. By trading on margin, you're able, though not obligated, to purchase more than you normally would. This is known as the leverage effect, and is the main reason why investors like to choose CFDs. For example, let's say stock ABC is trading at $10 US. You think the company's price is about to go up, so you buy 1,000 CFDs. Company ABC has a margin rate of 10%, which means you only have to deposit 10% of the total value of the trade as position margin. So, since 1,000 CFDs at $10 is $10,000, and 10% of 10,000 is 1,000, your position margin is $1,000. Now, let's say your prediction turns out to be correct, and stock ABC is trading at $15 US. Your 1,000 CFDs multiplied by 15 now equal $15,000. So you made a profit of $5,000 on your position while only investing $1,000. However, keep in mind, just like you can experience higher percentage returns with a CFD if the underlying stock goes up, you can also experience higher percentage losses if the stock goes down. Here are 4 reasons why you should trade CFDs. First, you can profit in both rising and falling markets. Second, due to the leverage effect, you can use your capital very efficiently. Third, the transaction costs are very low. And fourth, CFDs are flexible instruments that allow 24-hour trading and fast execution. Those are the basics.
So there you go. Now remember, CFDs are a popular way for investors to actively trade financial markets. This is because CFDs are, number one, tax efficient. If you're in the UK, you do not have to pay stamp duty. They're also flexible. You can trade on rising as well as falling markets. So it means you can go long or go short, as well as giving you leverage. Now, leverage products use a small amount of money to control a much larger value position. Now, let's talk about leverage. If you were going to go in and trade Forex, which is one of the most popular CFD formats, and you were going to trade the euro, which say is hypothetically selling today against a dollar for about 110.0472. That's 4 decimals to the right. That means a movement in the euro is moving 4 decimals all the way over there. Very rarely does the euro move more than a handful of pips in a day. A very good day might be 30 or 40 pips. But a currency doesn't move that much. But still, 40 or 50 pips, if you had enough of that currency, could be a lot of profit. So you need to be able to trade 100,000 euros or $110,000 worth of product. So if it goes up 50 pips, means you actually would have made $5,000. But do you have $100,000 or $110,000? No. But with leverage, you can secure and tie up a huge amount of currency because you only have to put a small percentage out. So at a 20 to 1% margin means to tie up that $110,000, you only had to put down $2,000. If it moves 50 pips, you made $5,000. Imagine that. You made $5,000 on your $2,500 investment. Now remember, it does have risks, and as much your profit mirrors your potential loss. So when you open a CFD select position, you select the amount of CFDs you would like to trade, and your profit will rise in line with each point the market moves in your favor. So in other words, if you traded gold, which say trading at $1,250, and gold went to $1,300, and you open up a contract for 100 ounces of gold, you would have made yourself $100. And those contracts would have cost you a lot less money. So I'm going to try to give you a little bit more sophisticated understanding on CFDs. And then we're going to talk about the difference between CFDs,
including shares, currencies, stock indices, commodities, and more. What is a CFD? A CFD is an agreement to exchange the difference in value between the price of a contract when it is opened and the price when it is closed. This means CFD trading, depending on your position, allows you to profit if the value of a share, for any market, moves down as well as up. And as you are only trading on a price derived from the underlying market value, this means you never actually own the share or asset, which can make it cost-effective. How does it work? Each share or asset has a buy and sell price, known as the bid and the offer, which is derived from the underlying market. If you think the market will rise in value, you buy at the offer price, called going long. If you think the price will fall, you sell at the bid price, called going short. The more the market moves in the direction you predicted, the more profit you make. The more the market moves in the opposite direction, the more you could lose. It is up to you how long you keep the trade open. What markets can I trade on? CFD trading isn't just limited to shares. You can trade on a huge range of financial markets from all around the world. Forex, commodities, stock indices, exchange-traded funds, and many more. Do I need a deposit? CFDs are leveraged products, meaning you only have to deposit a small initial percentage of your overall exposure to a market. For example, let's say you want to trade 10,000 shares in a big company. With traditional share trading, you would have to buy 10,000 shares at the full price. With a CFD, you only have to put up a small initial payment, as low as 10% of the total value. It's important to remember the risks of leverage. As your deposit is only a small part of your overall exposure, you can lose substantially more than your deposit if the trade goes against you. However, it is possible to reduce your potential losses by using a stop order. This means that a trade will automatically be closed if it goes against you by an amount you specify. What are the costs? In addition to your deposit, to open or close a CFD trade, you may have to pay a small commission, which can be as low as 0.1% for shares. Other markets, such as indices and foreign exchange, are commission-free. You may also have to calculate interest adjustments that are added or subtracted from your trade if you hold the trade overnight and consider any dividend adjustments. An example trade. The price of big company shares is currently $4.99, $5. You think the price will rise and want to trade 5,000 shares, so you buy at $5 for $25,000 total exposure, paying a 10% deposit of $2,500, which is the initial margin requirement. You pay 0.1% commission to open the trade. 5,000 shares times $5 per share times 0.1% gives us a commission of $25. It's near the end of the day and big company shares have risen to $5.10, $5.11 and you decide to take your profit. You sell 5,000 shares at the sell price, $5.10, and pay a commission on this example of $25.50. So your profit is calculated as follows. The opening level of the trade was $5. The trade was closed at $5.10, giving us a difference of 10 cents. 10 cents times 5,000 CFDs bought is a profit of $500. Costs of $50.50 with the commission, so our overall profit on the trade after costs is $449.50. CFD summary. CFD trading is a flexible alternative to traditional trading, with access to a full range of financial markets, and allows you to make money when markets are rising or falling. You don't have to put up the full cost of your exposure to the market, and there is no fixed time period to your trade.
Now, you have to keep in mind, always leverage. Okay. Now, it magnifies your profits, but it also magnifies your potential losses. So if price moves against you, you may be closed out of your position by a margin call or have to top up your funds to keep it open. So it's important to understand how to manage your risk. Now, spreads confuse a lot of people. Okay. So the best way I can explain them to you is it is the cost your broker assigns to the trade, so to speak. Okay, now, in the old days, if you wanted to buy shares of stock, your broker would charge you a commission. So remember, I don't know how old most of you are, if you were going on vacation or traveling out of your country and you needed to convert some of your money, whether you were converting $1,000 or 10,000 rupees, wherever you would go to convert your money, they would charge you a commission. So especially when you exchange small amounts of money on going on your vacation, it could have been a very expensive transaction because you're only exchanging $1,000 and they're charging you a $50 commission, but that's how the commission store made its money. Today, if you go in that same commission store, you have a big sign that says no commissions. And you see in there, we'll buy the euro at this price and we'll sell the euro at that price. So if you go in there with $1,000 and they're willing to sell you euros and they're willing to sell you euros at 110, you'll get 1,100 euros. When you come back from vacation and you find out you didn't spend those euros because you did everything on your credit card, and you hand them that 1,100 euros, he ends up handing you $995. You say, but why? It's the same thing he gave me. Because he's willing to buy it at a different price. Because again, it's his cost of doing business. Now, very rarely today does any broker charge you in CFD trading that small commission closeout. Okay. There is no commission. It's simply the spread. So and the spreads are kind of standardized. Broker to broker have different ones. The more popular the asset, the more liquid, the lower the spread. When you get out to trade exotics or very rare stocks, the spread gets very wide because it's the cost, not that your broker just arbitrarily wants to charge you. It's his cost for actually making that trade in the market, because he has less and less liquidity providers when it's an exotic than he does when it is, say, for instance, the euro. Okay. So keep that in mind. Okay. But don't make it overly complicated. Just say to yourself, when you buy at the buy price. That's the price that the broker is willing to sell it to sell it to you to buy. If you sell, the sell price is what the broker is willing to do the transaction for. They are competitive. You're not going to find a big difference between one broker to the next. Like I said, there's virtually nowhere I know of anymore that charges you commissions on CFDs. Now, the other thing is there are minor fees, because when you're trading on leverage, you're technically borrowing the money. Somebody has to put up the money. So if you're putting down $2,000 to control $110,000 of the euro, there is no fee for that, so to speak. But if you want to hold that trade open overnight, there is a minimum interest fee, and it is, again, very, 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 very small. But if you want to keep that trade because it hasn't made you profit today and you want to keep it till tomorrow, you can. You're not forced to ever close it. So that's very, very important. The next one that's a little bit confusing are dividends. If you're trading a CFD for a particular stock, and while you're holding that CFD open, that stock declares a dividend, guess who gets the dividend? You do. Now, it goes the opposite way if you happen to sell CFDs. So in other words, you sold those shares, and it happened to be that you sold those shares but haven't closed your trade and they declare a dividend, you would also see that dividend deducted. But that's very, very rare, and again, it's a small amount, but it's something you should be aware of. So remember, the spread, one is a buy, one is a sell. The difference between the buy and the sell is the spread. And the ultimate price that everything is based on mirrors the actual price of the asset in the market. So if hypothetical shares of stock were selling at 250 in the open market, okay, to buy them, you'd have to pay 251, or to go long. To sell them, you'd have to pay 249. Okay, so it is a competitive spread. Now, the nice thing also about CFD trading is you can do what we call stops and limits. When you place your trade, you can figure out what the lowest price or the highest price that asset can go that you can afford to lose. And you can place what we call a stop loss. In other words, you tell the system, if this asset falls below that price, close my position immediately. So that means you take a limited amount of loss. You can also take what we call a limit order. A limit order is telling the system that if the price ever reaches this, so let's stay with a buy. Say you bought gold at $12.50. You can't afford more than a $10 loss. So you tell the system, if gold falls below $12.40, close my position. If it happens, it will close your position automatically. but you think gold is going to go to $1,300 today. So you tell the system, if gold ever reaches $1,300, close my position and take my profit. So in other words, you can have a potential profit of $50 and a maximum loss of $10. Now, you know the price doesn't go straight up and down. So if for some reason the computer, not the computer, but the price blips up for $1,300 a second after you made that trade, it's going to close out your position and give you that profit. Now, you can physically move these at any time you want, or you can close your trade or keep your trade open. It's completely up to you. You can change them at all times. So a stop loss order is an instruction that allows the platform to close your open position once it reaches a level set by you. This will, as the name suggests, be the price below the current market level and be triggered on losing trades to keep it to the minimal loss. The other thing is you can tell the system to only open your trade. Say if you think gold's going to go up from 1250 to 1300 and it may drop to 1240, but you're not sure that gold's going to really rally, so it's trading at 1250 now. You don't want to actually enter the market unless it goes above 1256, say. You see it start to rally. You can tell the computer anytime you want, when gold hits 1256, then open my position. So you've placed a limit order. I'm sorry, you placed a limit order to buy when gold hits 1256, sell when gold hits 1240, and take your profit when gold reaches 1300. So it won't even initiate your trade or open your position until gold hits that 1256. So you have the abilities to do a lot of things to protect yourself. It's not very complicated things, but you're able to set it up. But having placed your trade and any stops and limits, your profit and loss of CFD will now fluctuate with each move in the market. You can track market price, see your profit and loss updates in real time, and add any new trades or close existing trades from your computer or by using your trading app on your smartphone. Once you are ready to close your trade, you need to just do the opposite trade of the opening trade. All you do is click the close position. So if you had bought an asset, it'll now sell it and close out your trade. If you had sold an asset, it'll buy it. By closing your trade, your net profit and loss will be realized and immediately reflected in your cash account. Now, there's many ways you can use CFDs. You can use it for hedging. You can use it to change your physical portfolio. You can use it for just making profit and loss. So are you ready? If you're ready, let's get started. Go to www.alvexo.com and open a demo account. Demo, D-E-M-O. Start trading with demo money. Don't throw your money away. Learn slowly. Open a demo account. Go along, get a handle on this. A demo account duplicates the real conditions. Once you're ready, then you can start out with small trades. So thank you very much for joining us. And again, go to www.alvexo.com and open a demo account and start learning all about CFDs and try it out, because knowledge and experience are the key to successful trading. Have a great day and thank you for joining us. Bye now.